I welcome you back to our discussion, and we look at an example from some of the previous past papers, and that is from Advanced Financial Reporting. That is November 2015, question 1B, and this is to do with consolidation of income statement as well as calculation of goodwill. Now remember, with the goodwill, we have two methods that we normally use. That is the full provision method as well as partial provision. Now, again, with the group accounts, especially the consolidated income statement, we understand how to consolidate income statements, and we'll be taking the revenue from the parent plus the revenue from the subsidiary. Cost of sales, we do the same. Expenses, we do the same. And then if there are adjustments, we adjust the items which should be adjusted for appropriately. That is like intra-company sales, things like maybe intra-company transfer of stock, that is, things like intra-company sales of non-current assets, and such other items as we discussed in our previous lessons. Important things to note when you are preparing consolidated income statements is that we should establish the percentages used. Like, for example, we know what a joint venture is. That's where you have a 50% by 50% shareholding, or where the investor has joint control. Where the investor has joint control, as a 50%, 50%, or maybe 50%, where we have a subsidiary, where the parent acquires more than 50% of the investee. That investee becomes a subsidiary. We can also have a situation where the parent has invested maybe less than 50%, but more than 20%, and that becomes an associate. Again, you can have a situation where we have acquired less than 20%. These are usually what we call financial instruments, which we account for as per the provisions of IAS 39. So we should understand these percentages in terms of control, and then after that we should be able to prepare our consolidated income statements. Now I want us to just go straight away to a question. We just go straight away to a question. I'll read it for you, and then I'll project it so that you may have a solution together. Now, I can read it as I projected before your camera. And this is the question. We are told that on 1st April 2015, H Limited acquired 75% of the equity shares of F Limited through a share exchange of 3 shares in H Limited for every 5 shares in F Limited. The nominal value of each share for both H Limited and F Limited is shillings 5. The shares of these companies were trading in the Securities Exchange at shillings 30 and shillings 16 for H Limited and F Limited, respectively. On the same date, H Limited acquired that percent of the equity shares of N Limited, paying shillings 10 per share. The nominal value of each of N Limited is shillings 5. Now, up to that point, something that we should note there is that because uh, H Limited acquired 75% of F Limited, obviously, H becomes the parent and F Limited is a subsidiary. Because we said a subsidiary occurs where we have acquired more than 50% of the investee. So in this case, H Limited has acquired 75% of F Limited. So F is the subsidiary. Now the remaining 25%, if we acquire 75%, then there is the remaining 25% which is remaining, and that figure goes to what we call non-controlling interest or the minority interest, the NCI, non-controlling interest, the 25%. When H Limited acquired 75% of F Limited, then the assumption that we make is that the remaining 25% was acquired by the non-controlling interest. That's an important point. Again, we are told that in this situation, we are not paying cash consideration to acquire the other company. We are paying in terms of share exchange. So our purchase consideration will be based on the share exchange, since we are being told that this was through a share exchange of 3 shares in H Limited for every 5 shares in F Limited. Okay, the other important point that we should note is that on the same date, H Limited acquired 30% of the equity shares of N. So we have F here, which is a subsidiary company, and then we still have N, which is an associate. An associate in the sense that we have acquired 30%. So this acquisition of that percent of the shares in N Limited makes this particular company to be an associate. F is a subsidiary because we have acquired 75%, and N is an associate because we have acquired 30%. Okay, the other part shows the statements of comprehensive income for the 3 years. Another point that we should note is that the date of acquisition, we are told the date of acquisition was 1st April 2015. And then these books of accounts, as you find in the question, we are told consolidated statement of comprehensive income for the year ended 30th September 2015. So the year ends 30th September 2015. It therefore means the year for this company starts 1st October 2014. So if the year for this company starts 1st October 2014 and the date of acquisition is 1st April 2015, It means that we are preparing these books of accounts for F and N for only 6 months. That is from 1st April 2015 up to the end of the year. Okay, I'll elaborate that one in a while. So I've explained that particular part which I have read for you. Now let's continue analyzing the question. Now you had told, so we have explained the first part. Then you can see the statement of comprehensive income for the three companies for the year ended 30th September 2015 are set out below. So you can see them there. H, which is a parent, F, which is the subsidiary, and N, which is the associate. Okay, you have sales there. We have cost of sales, gross profit, distribution cost, administrative expenses, finance costs, then investment income, profit before tax, income tax, profit and loss after tax. Then, so that was statements of comprehensive incomes for the three companies. Then we are given the summarized equity information for the three companies is that September 2015 is given below. So it appears there. Ordinary share capital, shillings 5 per value. Share premium, retained earnings 1st October 2015. Profit and loss for the year ended 30th September 2015. Then dividends paid 20th September 2015. Then additional information. On 1st April 2015, H Limited invested shillings 100 million in 10% debentures of F Limited. All interests accruing to that September 2015 had been accounted for by both companies. F Limited also and other loans in issue as at 30th September 2015. During the year ended 30th September 2015, H Limited sold goods to F Limited for shillings 120 million at a markup of 25%. 1/3 of these goods were still in the inventory of F Limited as at 30th September 2015. Number 3. As at 30th September 2015, the investment of H Limited in N Limited had been impaired by shillings 24 million owing to the losses that N Limited had made, or losses that N Limited had been incurring. Any goodwill arising on H Limited's investment in F Limited is not impaired. Number 4. An item of plant of F Limited and a carrying amount of shillings 96 million and a fair value of shillings 106 million as at the date of acquisition. This plant and a remaining life of 5 years as at the date of acquisition of the shareholding in F Limited. All other assets of F Limited and fair values which were equal to their carrying values as at the date of acquisition. So we turn to the next page, point number 5. Point number 5. F Limited hold a registered trademark with a remaining useful life of 5 years as at the date of acquisition. This trademark was valued by a specialist at shillings 40 million as at this date. This registered trademark had not been reflected in the financial statements of F Limited. Number 6. H Limited had included the whole of the dividend it received from F Limited in its investment income. Number 7. No fair value adjustments were required on the acquisition of the investment in N Limited. Number 8. The non-controlling interest in F Limited was to be valued at its full fair value as at the date of acquisition. Number 9. Incomes and expenses of all the three companies were deemed to accrue evenly throughout the year unless otherwise indicated. Required goodwill on the acquisition of F Limited's shareholding in F Limited formats. And number 2, consolidated statement of comprehensive income for the year ended 30th September 2015. So you can see that question there. You just go to the question and then we can have our solution together. Now the first thing is to show some illustrations. The first thing is to show some illustrations in that question. Now we start by showing our workings for each additional information. Now we have been told that now something that maybe I should show here is the group structure. Is my group structure here, if you allow me, and you can see that we are told H Limited acquired F Limited, and they also acquired another company, N Limited. So they acquired 75%. H Limited acquired 75% of F Limited. So the remaining 25% goes to NCI. We also told on the same date they acquired 13% of N. So N Limited becomes an associate. N Limited is an associate. So important thing to note here is that H is the parent or the holding company. They have acquired 75% of F Limited. So F Limited is a subsidiary and the remaining 25% will go to non-controlling interest. We also acquired that percent of N, and N, for that matter, is an associate. Another important thing that we should note is establishing the dates of acquisition. Now we have been told that the year for this company ends on that year, September 2015. You just look at the required portion where you are told prepare a comprehensive income statement for the year ended that year, September 2015. Therefore, this company does close their books of accounts on that year, September. Therefore, the year starts the next day, which is 1st October. 1st October. So it therefore means the year starts 1st October 2014. That is when the year starts. The year starts 1st October 2014 and it ends that year, September 2015. Now this is when this acquisition took place. We have been told that on 1st April 2015, 1st April, 1st April 2015, We are told on 1st April 2015, H Limited acquired 75% of the equity shares of F Limited. So this means from 1st April to that year, September, these are 6 months. These are 6 months. And the other part is 6 months. So we are dealing with 6 months. So most of the items will be apportioning using 6 months because this transaction took place just 6 months before the end of the year. Now I project some workings from the other side. Now just see these workings there, what we have done. You can be taking notes. Huh? Just take the notes. You can just prepare that. I'm talking about this portion here. You can draw this H limited. You can see 75% of F is what we acquired, and H also acquired N, that percent. You can see what we are saying there, that F limited is a subsidiary, that's 75%, and NCI takes the remaining 25%. N limited is an associate, and H is the parent. So you can see that the group structure is established there. Now here we have also shown uh, the date of acquisition is 1st April 2015. The year ends that year, September 2015. So these are 6 months there, and then the remaining 6 months. The year starts 1st October. We are told somewhere that profits are accrued evenly in the year, somewhere there. Now the other working is to do with the purchase consideration. I want to establish my purchase consideration out of that. Now realize what. Now show my workings a little bit faster. Now you have been told that as we have read earlier on, that on 1st April 2015, H Limited acquired 75% of the equity shares of F Limited through a share exchange of three shares in H Limited for every 5 shares in F Limited. The nominal value of each share for both H Limited and F Limited is shillings 5. The shares of these companies were trading in the securities exchange at shillings 13 and shillings 16 for H Limited and F Limited respectively. So we say that what you do to establish our purchase consideration, realize that we are acquiring a certain percentage of shares, and it is H which is acquiring F. So the first thing is to establish how many shares are we acquiring. If you look at F here, you can see that in the summarized equity information for the three companies, you can see ordinary shares. F, they have the shares is worth 960 million, and each share has a par value of shillings 5. So how many shares do we have? 960 divided by 5, we get 192 shares. If you divide this 960, because it is what we are acquiring, you divide by 5, we have 192 shares. Now the 192 shares which you have, you take 75% of that, and you get 144 shares. So check that working there. The number of shares here, the purchase consideration, how we are going about it. The number of shares you have taken 960 divided by 5, we get 192 shares. So we acquired 75% of that. We are told that H acquired 75% of those shares. So 75% of 192 is 144 shares. But we are told we are taking 3 for every 5. We are taking 3 for every 5 shares in F Limited. So if 3 shares in the parent is being exchanged at 5 shares in what is in F, then what about 144? You can just cross multiply this way. You can form this sort of a cross multiplication. 3 is equals to 5. What about the 144? This 144. How many shares shall we be receiving? So we are taking 144 times 3 divided by 5. If you cross multiply, then you multiply by 30 shillings to account for those shares in terms of shillings. We have been told those shares in the accounts of the parent are being recorded at that shillings. So 144 times 3 over 5 times 30 shillings. We get shillings for 25.92. Now the remaining goes to NCI. Remember, in the NCI, the assumption that we make is that when we acquired the 75% of the 192 shares, the remaining 25% was taken by the NCI from the market. And we are told the shares of F Limited are trading at 16 shillings in the market. So the remaining, if you take 25%, because it is what is remaining after we acquired the 75%. 25% of 192 shares is 48 shares. You multiply by 16, you get shillings 768. Okay, so that is my purchase consideration. Now the other thing that I will take, so we have seen the purchase consideration, what was paid by, you have seen what was paid by the parent to acquire the subsidiary is 25.92, and the NCI paid 768. Now look at the purchase consideration for the associate. How much did we pay to acquire? How much did we pay to acquire the associate? Right, we are told somewhere that on the same date, H Limited acquired that percent of the equity shares of N Limited, paying shillings 10 per share. The nominal value of each of N Limited is shillings 5. So you look at N here, we have that 320, and the par value is 5. So 320 divided by 5, you get 64. And then 64, you multiply by, so 64, we are acquiring that percent of that. And then you multiply by 10 to get 192. So show your workings this way. Your working number 2. The purchase consideration for the associate, the number of shares in N Limited is 320 divided by 5, which is 64 shares. So the 64 shares, because it is an associate where we acquired that percent, we take that percent of that times 10 shillings, you get shillings 192. So you can see my summary of purchase consideration. For F Limited is 25.92, for N Limited is 192, and also for the NCI we paid 768. So that is the analysis for that particular portion. Okay, we continue with the other side, whereby the other working is to do with additional information number 1. I hope you are writing your workings. Additional information number 1, we are told on 1st April 2015, H Limited invested shillings 100 million in 10% debentures of F Limited, or interest accruing to 30th September 2015 had been accounted for by both companies. F Limited also and other loans in issue as at 30th September 2015. So that is additional information number one. So simply, what is happening here is that the parent has invested in the debentures of the subsidiary. So simply, you cannot invest in yourself. You cannot invest in yourself. So by the end of the day, you expect the holding company to receive some interest, investment income in terms of interest, and you expect the subsidiary to pay that interest. So when consolidating the income statement, you'll be deducting these 5 as an income, and you also deduct it as an interest expense. So the most important thing here is to calculate the value. We have taken 10% of 100 million times 6/12 because we acquired this company 6 months towards the end of the year. So we get 5 million. So the interest on debentures is a 5 million, which you'll be considering when consolidating our income statement. So basically, additional information number one, you will be eliminating that interest income as well as eliminate the same figure as interest expense. Let's see number two, what will happen during the year ended 30th September 2015. H Limited sold goods to F Limited for shillings 120 million at a markup of 25%. 1/3 of these goods was still in the inventory of F Limited as at 30th September 2015. So simply, what happens is that these are intra-company sales. So if the group member sells to a group member, simply what you do is that you establish that portion of goods remaining in the stock by the close of the year. That portion which has already been sold to the outside uh, customers, that portion of profit has been realized. But that portion of stock which has not been sold has the unrealized profit. So first we need to establish what is the proportion which is yet to be sold. We are being told 1/3, 1/3 has not been sold. So establish what is 1/3 of 120, which I believe is 40 million, and then this 4 million, you establish what is the unrealized profit. We are using the markup here, and we are told the goods have been marked up at 25%. So to establish the unrealized profit, because you are given markup, you take 25 over 125 times that portion of 40, and I think you get 8. So that's the unrealized profit which you are supposed to establish, and we know how to account for the unrealized profit when consolidating the income statement. So that is for working number 2, which for additional information number 2, which I've shown you and I've explained. That's how you'll be going about it. Intra-group sales and unrealized profit is H and sold goods worth 120 million to F. So obviously, F is having the closing stock and H is having unrealized profit. So see how we have, you have said the closing stock here. We have taken the closing stock, 1/3 of those goods, 1/3 times 120, we got 40, and then what is the unrealized profit? 40 million times 25 over 125. We are told that these goods have been marked up at 25%. Because this is a markup, then to get the unrealized profit, you take 25 over 100 plus 25, which means 25 over 125 times that portion of the closing stock. Okay, so I'll be using 8 as the unrealized profit. So that is additional information number 2. Number 3, you check number 3 is that year, the September 2015, the investment of H Limited in N Limited had been impaired by shillings 24 million, owing to the losses that N Limited had been incurring. Any goodwill arising on H Limited's investment in F Limited is not impaired. So that's simply impairment in the investment in associate. There's nothing much there. We have been given the impairment there. So you don't need to calculate anything for number 3. Number 4, we are told an item of plant of F Limited and a carrying amount of shillings 96 million and a fair value of shillings 106 million as at the date of acquisition. This plant and a remaining life of 5 years as at the date of acquisition of the shareholding in F Limited, or other assets of F Limited and fair values which were equal to their carrying values as at the date of acquisition. Now that's important thing to note. So what we know is that if the carrying amount, which is also known as the net book value, is more than the net realizable value, then that asset is said to be impaired. And this is the opposite here. If this is the opposite, then there is revaluation gain. So in that point, there is a revaluation gain of the difference. Establish the difference between the carrying amount and the net realizable value to see whether there is a impairment or revaluation gain. In this case, there is revaluation gain of the difference. So if there is revaluation gain, that extra figure has to be subjected to depreciation. And then remember to apportion in 6 months, because we acquired that particular company 6 months before the end of the year. So establish the extra figure which is above the carrying amount, and then you depreciate that particular item. That is for additional information number 4. The working for that, you can see what you have done. Here, you are working number 4. You are writing that. That is working number 5. The carrying amount was 96 million, fair value 136. So the extra 40. 136 minus 96 is 40. 40, we want to see what is the depreciation per year. We are told the expected life was 5 years for that particular item. So 40 over 5, then 40 over 5 is 8. Then you multiply by 6 over 12, because we are interested with those 6 months which this business has been acquired. So the depreciation now for those 6 months, as you can see, is 4 years. Okay, you see where you use the 4 when consolidating the statement of financial position. Okay, move to number 5. Number 5, whereby is similar to what we have done. F Limited owned a registered trademark with a remaining useful life of 5 years as at the date of acquisition. This trademark was valued by specialists at shillings 40 million as at this date. This registered trademark had not been reflected in the financial statements of F Limited. So again, you do the same. This trademark, you just divide by 5. Is it 5? Was it for 5 years? The expected life. We are told the useful life is 5 years. So you take 40 over 5. We want to see the depreciation for 1 year. That's why we are dividing by 5. The expected life is 5 years. So 40 over 5, and then you multiply by 6 over 12. Because we are only interested with that portion which was remaining before the year came to an end. So amortization of the trademark is your working number 6. Show your working number 6. Amortization of trademark 40 over 5 times 6 over 12, which is 4. And we are through with our workings. We are through with our workings. The other items don't require any workings. That is additional information number 6, 7, 8, and 9. No working is required. So goodwill on the acquisition of H Limited's shareholding in F Limited. So goodwill, how do we calculate goodwill? Now goodwill, now just check from the board. Check your solution. But if you are not able to see well from the board, you can just solution for number 1. Goodwill. Check if you are not able to see from the board. You can see my goodwill. I've taken purchase consideration 2592. 2592. You remember how we calculated 2592? 2592, our working number 1. Refer to your working number 1. How we got 2592? So we have taken 2592 plus fair value, the NCI fair value, which was 768. Combine that, purchase consideration plus the NCI fair value, which is 768. Remember how we got 768? Refer to your working number 1. Refer to your working number 1. You get those numbers there, 2592 plus 768. And then you will be lessing net assets acquired. All the net assets acquired. You have your net assets acquired there. So remember, you got purchase consideration of 2592 plus fair value of the NCI 768. Total is 3360. You minus net assets acquired. Ordinary shares 960. Share premium, there was no share premium. Retained earnings, you have taken 1216 plus 234, which is 1450. Then evaluation reserve of 4050. 40 plus 40, that is, which is 80. Now let me show you ordinary share capital. Why are we using 960? Why are we using 960? Now 960 is the ordinary share capital of what we are acquiring. 960 is here. You can see 960. This is what we are acquiring here. 960. The ordinary share capital of F is 960. Share premium, there is nothing. No share premium. But how are we getting the retained earnings? Because we use profit as at the date of acquisition. We use profit as at the date of acquisition. Now we have taken, if you look at our workings for the profit or retained earnings on acquisition, we have taken 1216, 1216 plus 234. So 1216, the retained earnings which you have used there, to get 1450, it took 1216, which is a profit as at the start of the year. We started with 1216. However, we are told profits are, that is, incomes and expenses are accruing evenly, and you are given the profit by the end of the year for F Limited was 468. So 468 you divide by 2, you get to 34. That means from the start of the year up to the date of acquisition, we made a profit of 234. Then plus the opening balance of 1216. That is how you have gotten 1450. So we are taking 1216. We are taking 1216, which I think you can see somewhere here. This 1216 here is profit or retained earnings on 1st October 2014, which is 1216. Retained earnings on 1st October. So by the start of the year, F Limited and a profit of 1216. Then profits and loss for the year ended, that is September 2015, is 468. So that 468, we have been told that if you look at additional information number 9, incomes and expenses of all the three companies were deemed to accrue evenly throughout the year unless otherwise indicated. So this 268, that's the 468. We're assuming is that the 468, this 468, half of it. You know, when we acquired F Limited, it had a profit of 1216. Then from the start of that year up to the date of acquisition, this 468, we made half of it as profit. So our profit as at the date of acquisition means was 1216 plus half of 468. That is how we have gotten 1440. Then the other part was to do with revaluation. You can see the revaluation there of 40 plus 40. And that is to do with the PPE and the other patent. Now 40 plus 40, how are you getting 80? 80, the revaluation gain, or what is going to the revaluation reserve, is 1 is coming from point number 4. We in red number 4. So you say the 196 minus what? 96. If you look at point number 4, we got 40. The difference, that's a revaluation reserve. That was 140. The 40, and then the other 40 was coming from point number 5. The point number 5, the registered trademark, which was valued at 40. So those are the items that you will need when preparing your goodwill account. So your goodwill account, the answer should be 870. The goodwill on acquisition of F Limited, because question number 1, that is what they required. So you take the purchase consideration, which was paid by the parent, 2592, plus NCI fair value, 768. You get that 360, minus net assets acquired. Ordinary share capital, 960 is given. Share premium, there is no share premium. Retained earnings as at the date of acquisition, 1450. We have seen how we have gotten that. Then revaluation reserves, 40 plus 40. So you less all that, your goodwill is 870. Okay, that is it about that. You can still check the same workings on the board here. You are able to see the purchase consideration. How much did we want to check? What's the goodwill on acquisition of F Limited? What is the goodwill on acquisition of F Limited? We take the purchase consideration, what the parent paid to acquire the subsidiary, 2592. You have shown that. Then the NCI fair value, which is 768. In that figure, you less the net assets acquired. You just look at what are we acquiring from the subsidiary F. Ordinary share capital is 960. There is no share premium. Then retained earnings 1216. 1216 was the opening balance for the profit. But from 1st October 2014 up to 1st April 2015, when we acquired the subsidiary, we made a profit of 234 because we have been given the total profit for the year, which was 468, and we are told these incomes and expenses are accrued evenly. So that half, the 468, half of that is 234. So the profit is at the date of acquisition. We are taking the opening balance plus that profit which was meant for those 6 months, which is 1450. Then revaluation reserve. There was a revaluation reserve for the PP and also that particular trademark, 40, and the other was 40. So you less all that, the goodwill, you get 870. So that 360 minus this portion, the goodwill is 870. Then lastly, the last part, so I believe you have understood how you have calculated your goodwill. Now the last part is to do with consolidated. The last part, they are asking you, number B, so number one was goodwill on the acquisition of H Limited's shareholding in F Limited. Then consolidated statement of comprehensive income for the year ended 30th September 2015. So usually what you do when consolidating is that you just take the, now let me show you the solution so that you can understand that consolidation. Now look at our solution. You can just first understand that solution. Check the solution. Consolidated, the H group consolidated statement of comprehensive income. You can see we are taking the sales for the parent, which was 1680, plus 1200 for F. Remember, F was the subsidiary. We are multiplying by 6 over 12. Why? Because we acquired this company 6 months before the end of the year. Then you minus 120. So why are we minusing 120? We are minusing 120. We are minusing 120 because we made sales to a group member and we can't make sales to ourselves. You can't make a sale to yourself. So you minus that particular 120, the entire figure. So when consolidating, you have taken sales revenue for H, 1680, plus F, 1200. Now this 1200 was for the entire period, but we acquired this company 6 months before the end of the year. So you multiply 1200 times 6 over 12. And then, remember, we don't consolidate N Limited because N Limited is an associate. We don't consolidate associates. In that case, there is a special way of treatment of associates when preparing consolidated income statement. So you have taken 1680 plus 1200 times 6 over 12 minus 120. The 120 is in additional information number 2. Number 2. Number 2, you can see what we are told. That during the year entered, that is September 2015, H Limited sold goods to F Limited for shillings 120 million. So you can't sell goods to yourself. So you eliminate that particular figure. And that is the reason as to why when consolidating that particular figure, you have taken, see the sales, how you have gone about it. 1680 for the parent plus 1200 times 6 over 12, because it was 6 months subsidiary, minus 120, the total sales. You can sell for yourself. You get 2160. Then cost of sales, you just take the cost of sales for the parent, 630, plus 500 for the subsidiary, times 6 over 12, plus 4 plus 4 plus 8 minus 120. So 4 was the depreciation, and 4, again, the other 4 is also for the depreciation. 8 is the unrealized profit in the closing stock, and you minus the 120, the same 120. Because when we talk of sales, we are minusing 120 on both sides, because when H sold to F, H is saying we made sales. Then the purchasing group member, which is F, they are talking about purchases from a group member. So again, you have to less the same 120 as cost of sales. We know how to calculate cost of sales. Opening stock plus purchases minus closing stock. So you have understood with the sales why we are minusing 120. Because we have been told, if I can get that point correctly, is during the year entered 30th September 2015, H Limited sold goods to F Limited at shillings 120. So, to one group member, it is a sale. To the other group member, it is a purchases. So that figure, you are lessing it as sales, and you're also lessing the same figure as purchases. Now, when you go to the cost of sales, you take the cost of sales from H, which is the parent cost of sales, as it is given in the question, 630 plus that of F, 500 times 6 over 12. We are portion, because we acquired that company 6 months before the end of the year. You apportion those sales. The 500 is for the entire period, the whole year, but we are interested with the 6 over 12, the 6 months, because we are told revenue and expenses are accruing evenly. So 500 times 6 over 12. Then plus, these are the depreciations. 4, I just show you where this 4 is coming from. 4 and 4 and 8. 8 is to do with the unrealized profit on the closing stock, which has been entered here. Then this 4 is the depreciation, which is working number 5 and 6. Refer to working number 5. Refer to working number 5 and 6. Planned, we said 1 that 6 minus 96, we got 40. Then 40 divided by 5 times 6 over 12, which is 4. The depreciation was 4. The other was for amortization of the trademark, which was 40 over 5 times 6 over 12, which is 4. And then the unrealized profit on the closing stock, which is 8 here, was working number 4. So number 4, working number 4, 5, and 6 tells you where those figures are coming from. So you have understood cost of sales, the cost of sales, where those figures are originating from. The cost of sales, you can see the cost of sales, 630 plus 500 times 6 over 12 plus 4 plus 4 plus 8 minus 120. 120 was the sales, which we have subtracted again up there. 4 is the depreciation. The other 4 is amortization of the trademark. The other 8 there, and you realize profit. So we are lessing 776. So gross profit is 1384. Then gross profit we usually earn other incomes. We have investment income. Now something which is important for you to note is the 5. If we did additional information number 1, and we had been told you refer to additional information number 1. You had been told that on 1st April 2015, H Limited invested shillings 100 million in 10% debentures of F Limited. So at that point, we say that because this is an investment, the investor is receiving interest income, which is 5 million, and the investee is paying 5 million as interest expense. But you can't really receive income from yourself. So when consolidating, what you do with that investment income, you can see we have taken 76. We are given investment income. Remember, we are consolidating. We have investment income. You can see investment income somewhere there. Investment income of 76 in H. For F, there is no investment income, and for N, there is no investment income. So investment income 76. We are taking 76 now minus 5. 76 minus 5. We are minusing 5 because when we invested in those debentures, we are receiving interest of 5. But we can't receive income from ourselves. Then we minus the dividends now, 64 times 75% times 6 over 12. That portion, 64, we are taking 64, we will receive 75% of that. Okay, let me show you what I'm talking about. The 64. We are receiving dividends. You can see dividend paid 20th September. They were coming from F Limited. So this 64, what the parent will receive is 75% of that. 75% of that is what you receive, but again, you have to apportion that time. Apportion that time by 6 over 12. So investment income 76, we minus 5, we also minus the other portion, which is 47. Now expenses, those are straightforward. Expenses, we have not much problems with that. Distribution cost, you take 89.6 for the parent plus 56 times 6 over 12 for the subsidiary. Administration expenses, 146.4 for the parent plus 72 times 6 over 12. Finance cost, 14.4 plus 24 times 6 over 12 minus 5. We are minusing 5 is the interest which F paid to the parent. The same 5 that is appearing in the investment income. That 5 there, investment in 10% debentures, that 5. It is like an income to the parent, and expense to the subsidiary, but we can't really pay ourselves and we can't really receive money from ourselves. So look at distribution cost, administration cost, and finance cost. Then you get profit before tax. Okay, maybe you did not understand what I'm doing, but I can just show you distribution cost. What you are doing when you are consolidating, you just pick distribution cost for H, which is 89.6 plus 56 times 6 over 12. 56 we are multiplying by 6 over 12 because we acquired that company 6 months towards the end of the year. We got 117.6. Administration costs, we do the same. Administration costs, you take 146.4 plus 72 times 6 over 12, and you get 182.4. Finance cost, you remember the 5. The finance cost, you have 114.4 plus 24 times 6 over 12 minus 5. You get 21.4. Then when you less all that, what you get is can just check your expenses. Can check your expenses, distribution cost, administration cost, finance cost. You get profit before tax of 1,109.6. Then you less the tax expense. Tax expense 120 for the parent plus 8 times 6 over 12 for F. So you are lessing 160. And you get profit after tax of 949.6. Okay, what I've not shown you is tax expense, where the tax expense is the income tax. Income tax is 120. Income tax 120 for the parent plus 8 times 6 over 12. Okay, so you get the profit. If you less that, you get the profit after tax. And then lastly, the last point, because we have the other sheet, you can see we are not consolidating the other sheet line by line. We are not taking maybe the sales for the other sheet, that is N. We are not taking the cost of sales for N. We are not taking any expenses for N because N is another sheet. Now this is how you are supposed to account for the other sheet. What you do, you earn the other sheet share of the profit after tax. So what you do, in this case, because you have gotten your profit after tax at 949.6 out of the profit of the other sheet, how much are we supposed to get from that particular profit? And unfortunately, they reported a loss. So we will be receiving a loss. So that loss that we are receiving from the other sheet will reduce our profit, definitely. So you take 40 times 30% times 6 over 12. 40. Where is 40 coming from? We know that percent is the proportion that we acquired of the other sheet. But where is 40 coming from? Where is the 40 coming from? 40 is coming from here. You go to the statement of comprehensive income and you find here, this 40 here, a negative. Profit and loss after tax we are talking about 40, where you have N limited. N limited is an associate. We don't consolidate associates line by line. So we invested that percent in N, and we only N reported a loss of 40. So by the end of the year, we will receive that percent of this 40. But 40 was acquired 6 months towards the end of the year. So we apportion that particular item. So we earned associate share of profit after tax 40 times that percent times 6 over 12, and you get so 40 is a negative actually. So what we are sharing from the associate is a loss of 6. So profit for the year or profit for the period is 943.6. So basically that is the solution for that. Now you can just recapture your workings. If you can see very well from the board, so you can just start by reviewing. You can review your workings if you did not see well. Starting from there, you see our group structure. H acquired 75% in F Limited and that percent in N Limited. And therefore, F Limited is a subsidiary, 75%, and the 25% goes to NCI. N Limited is an associate, that percent. H Limited is the parent. So we are given another analysis there showing that F Limited is a 6-month subsidiary because you can see that their year starts 1st October 2014 and they close their books on 30th September 2015. The date of acquisition for both the associate and the subsidiary was 1st April 2015. Then profits are accrued evenly in the year. You can see how we have divided the profit for each half year. 468, which was given, divided by 2, we got to that 4. And then profit is at the date of acquisition, 1216 plus 2, that 4, which is 1450. Then there were working number 1 for purchase consideration. We have discussed all that. Then we went to the other workings and we showed investment in a debenture, intra-group sales. We got markup. We got an unrealized profit of 8. Then there was a plan or evaluation of the planned amortization. We got 4. Then the goodwill, we have shown the goodwill there, which was required, the goodwill. And then the other part, which we have just concluded, is H group consolidated statement of comprehensive income. It appears that way. So finally, because you have the solution with you, the question originally was that. Originally, that was your question. November 2015, question 1B. That was your question. That was your question. You also went all the way to the other side. It went all the way to the other side. 5 up to 9. We are required to calculate goodwill on the acquisition of H Limited shareholding in F Limited, as well as consolidated statement of comprehensive income for the year ended, that is September 2015. Well, I think that's job well done. That's job well done. So, what we have explained, or what we have simply discussed today, is how to consolidate, a statement, how to consolidate comprehensive income statement, and how to calculate goodwill. Is advanced financial reporting, November 2015, Kasneb, question 1B, November 2015, question 1B, advanced financial reporting, Kasneb. We were required to calculate the goodwill, and there are two methods of calculating goodwill, and one is known as partial provision, the partial provision method, whereby you only consider that goodwill which is accounted for on the part of the parent. And then we have full provision method, whereby you have to recognize the goodwill on the side of the parent as well as the goodwill on the side of the NCI. Now again, if impairment has been provided, if you are told that goodwill has been impaired, then you have to um, report the goodwill net of impairment. You have to show impairment. You less the impairment on the side of the NCI as well as on the side of the parent, basically. So, but in our case here, this goodwill, which we got at 817, there was no impairment. Goodwill and not being impaired. We got goodwill of 870. We just took the purchase consideration because what we have used here is full consolidation method. Purchase consideration, how much did the parent pay to acquire the subsidiary? In this case, it was a share exchange, and we have shown the workings of how we got 2592. Purchase consideration, how much do we pay to acquire the subsidiary? We paid 2592 plus NCI fair value, the fair value of the NCI, which we have also shown 768. Sum the two, and then you less the net assets acquired. What we acquire is the net assets, things like share premium, revaluation, profit as at the date of acquisition, ordinary share capital, and such. So we have all these items here constitutes net assets which were being acquired. So if you take the purchase consideration paid by the parent to acquire the subsidiary plus the fair value of the NCI, then you less the net assets acquired, what you get is the goodwill. So this is full goodwill. We are not showing what portion of this goodwill goes to the NCI and what portion goes to maybe the subsidiary or the parent in that matter. So we are reporting just one figure. But if there is need to show what portion goes to the NCI and what portion goes to the parent, then it is again possible to do that. But for the sake of this question, that was not the case. They just wanted us to show the goodwill using the full consolidation method as the question demanded. So with the calculation of goodwill, I think we are conversant, we are familiar with that portion. And the other part was to do with consolidation of income statement. When consolidating income statement, remember you just take the sales of the parent plus that of the subsidiary. Do not consolidate the sales of either the associate or the joint venture. That is done in a different way. So you can see what we have said is that we have taken the sales of the parent plus that of the subsidiary minus, you check whether there was intra-company sales. If a group member makes sales to a group member, then you can't make sales to yourself. You have to eliminate the entire figure, the entire sales. Once you amalgamate the sales for the parent and the subsidiary, then you less any total sales which were made. You can't really make sales to yourself. And the same sales must be deducted on the side of the cost of sales. And that is why down here we still deducted 120. Because when I say that H Limited, which is the parent, sold goods to the subsidiary, then to me as the parent, that is a sale. But to the subsidiary, which is F in our case, that is a purchase. They are talking about purchasing goods from the parent. The parent is talking about selling goods to the subsidiary. So if I'm lessing these sales here, I should as well less the same figures down here as sales. We have to eliminate the entire figure. The cost of sales, we know what it is. We know it's given by opening stock plus purchases minus closing stock. And then check things like depreciation and the unrealized profit, which is overstating your closing stock. You have to sum them together here so that you may less the entire figure there to get the gross profit. Investment income, check whether there are other incomes. You earn them there. Then less all the expenses. You less all the expenses. You still amalgamate the expenses. Take the expenses for the parent plus that of the subsidiary. And then remember to apportion the expenses for not only the expenses, including the sales and other items, based on the time for that particular year that we are dealing with, for which this particular subsidiary lasted. We acquired this subsidiary 6 months before the end of the year. That is why we are most of the items here you can see we are multiplying by 6 over 12. Okay, so once you less all that, you'll be getting profit before tax, less the tax. You do the same, take the tax for the parent plus that of the subsidiary, but a portion in 6 months, you get profit after tax, and then you earn associate share of the profit after tax. In that case, it was not a profit. The associate, that is N, reported a loss of 40 million. And out of that loss, you just take that percent because we invested that percent in that associate, and then you apportion the same figure by 6 over 12 because it was acquired 6 months before the end of the year. After all that adjustment, you get profit for the year, which we got 943.6. So that is the end of that. And I remind you to subscribe to our YouTube so that whenever we upload a video, you are able to get the update. So the examination is starting next month. That is the first week of December 2025. So make sure you subscribe so that you'll be getting these revision classes as and when we do them and upload them. My number is here 0727871093. 0727871093. Can start with plus 254 if you are in foreign countries. Plus 254 727871093. So you can just get us YouTube. That is Fatima Institute. We have Fatima Institute. Fatima Institute. That's our YouTube account. You can get us from there. So be getting these classes for revision or studies, online classes. You still have online classes. You go to our YouTube, you find some discussions there for CPN, also CIFA and ATD. So you can subscribe so that you'll be assisted in your revision. My numbers are there. You get us again in our YouTube account, Fatima Institute. So the next lesson that we will be taking, because I think you are able to know how to consolidate income statement and how to calculate goodwill, we will take a question which is to do with consolidation of statement of financial position. We also take foreign branches, how to prepare the books of foreign branches, and then that will be the end of group. So we will finish up our calculations with The next chapter, which is to do with the books of accounts for the banks and insurance, and then EPS, and then external and internal reconstruction. Those are the major areas which are remaining now. So we can clear the syllabus next week so that now we can start attempting some other past papers. So that's enough for today. Thank you. We just meet again next lesson.